There is a section of the IRS tax code that lets you, as a grandparent, pay for your grandchild's entire college education, $50,000, $100,000, even more, completely free of gift tax, without using up a single dollar of your lifetime gift exemption, and without filing a single tax form. Most people have never heard of it. The ones who have usually do it the wrong way and accidentally trigger taxes and paperwork they never needed to deal with. Here's what makes this so powerful for seniors. If you have money set aside and grandchildren you want to help, this one move lets you transfer a huge amount of wealth to the next generation. Shrink your taxable estate and put a grandchild through school all at the same time. All tax-free. Stay with me, because I'm going to show you exactly how this loophole works. The one critical rule you must follow, or you lose the entire benefit. And the common mistake that turns a tax-free gift into a taxable one. And there's a second part to this that almost nobody knows. The same rule that covers tuition also covers something else entirely that can save your family thousands more. I'll tell you what it is in a moment. Because once you understand both halves of this, you'll see why the wealthy have quietly used this for decades. What this loophole actually is. Let me give you the real name, because you'll want to look it up. It's found in Internal Revenue Code Section 2503E. And it's called the Qualified Transfer Exclusion, but most people just call it the Direct Tuition Payment Exclusion. Here's the normal rule first, so you understand why this is special. Every year, you're allowed to give any one person up to a certain amount in 2026. That's $19,000 without any gift tax consequences. Give more than that, and you either have to use part of your lifetime exemption or file a gift tax return. But Section 2503E carves out a massive exception. If you pay tuition directly to a qualifying school, directly to the institution, not to the student, that payment is not considered a gift at all for tax purposes. There is no dollar limit. None. Listen to what that means. A grandparent can pay $55,000 a year in tuition directly to a university. And it does not touch their $19,000 annual exclusion. It does not reduce their lifetime exemption. And it requires no gift tax form. As one estate attorney put it, from a tax perspective, it's as if the gift never happened. Think about a real scenario. A grandparent wants to fund a grandchild's medical school, $75,000 a year for 4 years. That's $300,000. If they wrote that as checks to the grandchild, it would be $300,000 of taxable gifts, eating deep into their lifetime exemption and requiring a gift tax return every year. But written as 4 checks directly to the medical school. 0 reportable gifts. 0 exemption used. 0 forms filed. But here's the catch, and it's the single rule that decides whether this works or blows up in your face. Get this one detail wrong, and you lose the entire benefit. The one rule you cannot break. This is the most important sentence in this entire video. So listen closely. The payment must go directly from you to the school, not to your grandchild. Not to your adult child, not into the student's bank account, directly to the institution's bursar or tuition office. The moment that money passes through the student's hands first, the IRS no longer treats it as a qualified tuition payment. Instead, it becomes a regular gift to the student, and now it's subject to the $19,000 annual limit. And anything above that starts eating your lifetime exemption and triggering paperwork. So the mechanics matter enormously. You call the school. You ask the bursar's office how to make a direct tuition payment on behalf of a student. You write the check to the school, or you wire it to the school, with the grandchild listed as the student it applies to. That's it. The money never touches the student. And because of that, it's completely outside the gift tax system. Here's another mistake people make. Paying off a grandchild's existing student loans does not qualify. The IRS treats loan repayment as a gift to the person, not a direct tuition payment. So if your grandchild already borrowed the money and you pay off $50,000 of their loans, only the annual exclusion amount is protected, the rest is a taxable gift. The lesson: pay the tuition directly, before they take out loans, not after. Now here's that second half I promised you, because this exclusion covers more than just tuition. And this is where it gets even more valuable for a senior. Asterisk asterisk the hidden second half, medical expenses dot asterisk asterisk. Here's the part almost nobody connects. That same section of the tax code, 2503E, covers two things: direct tuition payments and direct medical payments. That means you can also pay someone's medical bills directly to the hospital, the doctor, or the insurance company with no gift tax, no limit, and no effect on your exemption. You could pay a grandchild's surgery bill, cover a family member's health insurance premiums, or handle a medical emergency, all completely outside the gift tax system, as long as you pay the provider directly. For a senior thinking about how to help family and reduce a taxable estate at the same time, this is enormous. Between direct tuition and direct medical payments, you can move large amounts of money to your children and grandchildren every single year, on top of your regular $19,000 annual gifts to each person, without any of it counting as a taxable gift. But what if your grandchild is young, and college is years away? There's a related strategy for that, and it has its own surprising advantage. Let me explain. Asterisk asterisk what to do if college is still years away, the 529 option dot asterisk asterisk. The direct tuition exclusion is perfect when the bills are due now. But if your grandchild is still a child, you might want to set money aside to grow. That's where 529 college savings plan comes in. And it pairs beautifully with this strategy. A 529 plan lets your contributions grow completely tax-free. And withdrawals for qualified education are tax-free too. And there's a special move just for these accounts called superfunding. In 2026, you can put up to $95,000 into a 529 for one grandchild in a single year, or $190,000 for a married couple, and treat it as if it were spread evenly over 5 years. Avoiding gift tax. Here's a bonus that changed recently and matters a lot. Thanks to updates to the financial aid form, the FIFSA, money in a grandparent-owned 529 plan is no longer counted against the grandchild's financial aid. It used to hurt their aid eligibility. Now it doesn't. So a grandparent can fund 529. Control the money. Watch it grow tax-free. And it won't reduce the grandchild's scholarships or grants. The difference between the two strategies is simple. If tuition is due now, pay the school directly under the 2503E exclusion. If college is years away, consider 529 so the money grows tax-free in the meantime. Many families use both. So let me put this all together into a clear plan you can actually act on. Your step-by-step plan. Here's exactly what to do. Step 1. Decide your timing. Is tuition due now? Or is your grandchild still years from college? That determines which strategy you use. Step 2. If tuition is due now, call the school's bursar or student accounts office. Ask them the exact process for making a direct third-party tuition payment on behalf of your grandchild. Get the payment instructions in writing. Step 3. Make the payment directly to the institution by check or wire with your grandchild identified as the student. Never route the money through the student or their parents. Keep your receipt and the school's confirmation. Step 4. Remember it's tuition only. Room and board, books, and meal plans, and laptops do not qualify under the direct tuition exclusion. For those, you can still use your regular $19,000 annual gift to the student. Step 5. If college is years away, look into opening a grandparent-owned 529 plan. Compare your home state's plan for possible state tax deductions. And consider the superfunding option if you want to move a large amount at once. Step 6. For anything large or complex, especially if your estate is sizable, talk to a tax professional or estate attorney. These strategies are simple, but coordinating them with your overall estate plan is where a professional earns their fee. Here's the bottom line. Most families pour their attention into that $19,000 annual gift limit and completely overlook one of the most powerful wealth transfer tools already written into the tax code. Direct tuition payments and direct medical payments let you help the people you love the most, your grandchildren, while quietly shrinking your taxable estate. With no limit, no forms, and no tax. This is not a trick, and it's not a gray area. It's a clear provision of the law that the wealthy have used for generations, and it's available to any grandparent with the means and the desire to help. The only reason most people don't use it is that nobody ever told them it existed. So if you have grandchildren and you want to help with their education, remember the one rule that makes it all work. Pay the school directly. And if you know a grandparent who's planning to help with college or who's about to write a check the wrong way, send this to them today. One direct payment, done correctly, could move tens of thousands of dollars to the next generation. Completely tax-free.